Well, good evening, everybody. Hopefully, you guys were able to read what I entered and not what I wrote. But I scheduled our Facebook Live in writing for 8 p.m., but it's actually at 7 p.m. Eastern. So I apologize for any confusion that might have caused. And thank you guys all for coming in and joining. It's really good to be with you again. Um, I am in a different place today. I am got this lovely background of saints, so hopefully that's got some inspiration for you, especially during this wonderful Holy Week. We're going to do something just really short tonight. It is Holy Week. This is such a beautiful time. Holy Wednesday. It's a time to start reflecting on what we've gone through during this time of Lent, through our time of struggle, and into this beautiful time of Easter. It's a really tough few days coming up, and going through and walking through the suffering of our Lord, um, leading us to that glorious gift and his resurrection and that beautiful gift that he has given us on Easter. So I'm not going to do a really long event tonight. I am going to do this kind of short, but it is our tradition. We do have these Facebook events every first Wednesday. So even though it is Holy Week, I did still want to come to you guys and give you this. So again, if you're not live, not to worry about it. Um, uh, Catch it later. Not a problem at all. I hope you guys are having had a beautiful Lent and are excited about the Easter time to come. I know there's some great things that my children and I do together, and my husband, and so we're looking forward to that. So just to get us started, without delay, 10 things to know about your money. And as always, if you have any questions, please feel free to add those in the chat, and I will try to get all of those answered for you. So normally we talk about all the normal stuff. We talk about budgeting and how to do a budget and coaching and all of that. And some of that will apply to some of these 10 things to know about your money. But it comes to them from a slightly different view. So the first thing is something that we don't talk about a lot is advisors. So there are some of you that are using a financial advisor to help you manage your money. This is something an advisor can help you. It's not one of these things, if you're like me, when I first started, I was like, okay, I do not have near enough money to use a financial advisor. This is something for other people. This is something for people that have money. I definitely don't have money and I don't have it. And I came to find out that a financial advisor is actually very helpful. And you can start putting money aside systematically for retirement as little as $25 or $50 a month. So we do recommend taking advantage of your 401k or 403b if you have that. But if you would like to also save with an IRA, this is definitely something an advisor can help you with. So some advice, we don't do any recommendations, but some advice when working with this advisor would be to find out how they're compensated. And the reason you're finding this out is there's two reasons you want to know this. One of them is you need to know if there's any conflict of interest. So are they recommending certain products because they receive extra benefits from those products? And that's just to see if they have any bias, any conflicts of interest that are going to incentivize them to recommend certain products to you. Maybe they get paid more for recommending insurance, and now you know why they're pushing your insurance for you to purchase that. Or different fund companies. The other thing that's going to help you with is you're going to know how they get paid, and knowing, do these companies pay them just based on the products that they sell to you, or do they get compensated by a straight fee? So sometimes advisors, you're going to go in and you're going to pay them a certain amount of money and they'll create a financial plan. And then if you invest with them, it's a certain amount of money that you will pay. And those funds will be used. It's just to pay for their services. And then whatever money you make, if you make fund money, if you don't make money, then they still get this flat rate. And the other way they get compensated is based on what they sell to you. So if they sell you a mutual fund, then they earn a commission from that mutual fund. A third way they can get paid is they can get paid, and this is usually for people who have a little bit more money, closer to retirement, and you've saved up. And this is based on how much you have invested with them. And, that point of view is the better you do, the better they do. So they're kind of incentivized to help you out. Um, so it's really more of finding that answer and then finding out what you're comfortable with. There's some people that are more comfortable saying, I'm going to pay you a flat fee, and then I know you're not incentivized to sell me any specific products. Or you might be one that says, you know what, I understand that if you sell me a product and you get a small portion of that fee because of the work that you do, then that's kind of how would the relationship I would like. There's plenty of advisors out there that do both of these, so definitely find somebody that works with you and in your comfort level, and then you're able to uh, um, find that advisor for you. So a second thing to look out for, something to know with your money is, um, what is your net worth? So a net worth is calculated by adding up all of your assets and subtracting your debts. So if this is a negative number, it's time to pay down your debt because that means you owe people more than you have in your assets. So assets are going to be your home, your car, cash that you have in the bank. The goal is that as you start increasing and saving for retirement, your amount of your investments goes up and the amount of debt as you pay it off that goes down. So that's kind of what you're looking for. And one rule of thumb is to check this at least, you can check it quarterly if you're trying to pay off debts. If you already have your debts paid off, then this is something that you can check on a more annual basis, as just to kind of see how your investments are doing. So when you look at your financial goals, and if you are doing any investments, then what you would need to look at is, what is your risk tolerance? So something to know when you're investing is you want to know what is your risk tolerance, and what that's going to say is when you put your head on the pillow at night. And I'm sure you've heard me say this before. As you put your head on the pillow at night, are you concerned about your finances? Is there something that keeps you up at night? And if there is, and that might be saying that how you're invested is a little more risky than you want, or conversely, maybe it's not risky enough. Maybe this is something where maybe this is something that you would like to be in a little more of an aggressive investment. Maybe you think that, well, I want to take advantage of a certain part of the market or something like that. So knowing what your risk tolerance is and how you view that is definitely important. And the other thing you need to know is time frame. So the farther out your goal is, the more time you have to achieve it. And that's also going to determine where you save your funds. So if you're saving to buy a home and you're thinking, okay, I need a down payment for my home and I'm going to buy this home within the next 5 years, you do not have enough time to take advantage of some of those ups and downs in the market. So the funds you save, you definitely want to make sure that those funds are going to be available to you when you need it. So this is funds that you're going to put in a savings account, and they'll be there, they'll be secure. That right now we're getting better interest rates, so you'll earn a little bit of interest. Now, if you're saving for a home and you're not doing this for maybe 10 years, that's when I would put it into an investment account, because then you have time to take advantage of the ups and downs in the market. The market goes down, but it always does go back up. We are kind of in that little upside down phase right now. We did really well for a few years, and now we're not as well as we had been, but I have complete confidence that things will go up. I'm just really positive as far as that goes. Word of warning. There are no guarantees when it comes to investments. So if you do have a financial advisor that is promising you a definite fixed return and it's not in, there's a few investments as far as bonds with the government and stuff that you can get a more guaranteed, but it's an investment, and investments do have a little bit of risk to them. And that risk is, there's no guarantee that those funds would go up. So be wary if your advisor says, I have a guaranteed investment. At the same time, you need to be careful if your advisor is telling you this is a once in a life opportunity and you need to act right now and make a decision. So there's a lot of things in our life that happen. There's a lot of things that require last minute decisions, whether it's with our family, whether it's work, and some of these are financial. But when it comes to your investments, especially long-term investments like education or retirement, these are not the kind of decisions that you have to just jump on right away. The best way to make gains in your investments is the steady investment that happens over time of dollar cost averaging, where every month you put in the same amount of money, you put it in, and let that take advantage of the ups and downs in the market. It's not going to be that great investment thing that you see come out. That's not where you're going. You might, but that's typically not where you're going to see it. And these are red flags and something that you need to bring up with your advisor. Let them know, this is not something I'm comfortable with, and maybe time to start looking for a new one. Along with that is what is your retirement savings rate? And this is how much are you saving for retirement? So when you save for retirement, are you saving enough to reach that goal? So when we decide how much we're saving, we're going to start with the end in mind, and we're going to say, when I retire, this is how much I need. My income is this right now, and so I need to replace, this much of my income, 70 to 80% of my income. How much is that going to be? And am I savings enough to get there? So number one was find out about your advisor, how they're compensated. Number two was check your net worth. Number three was your financial goals need to have a time frame and are invested within your risk tolerance. And number four is know your retirement savings rate. All right. So change lanes a little bit, and we're going to talk about insurance. And there was a great post that one of my team workers just posted in the group. Be sure to check that out in our Changemakers Facebook group. If you're watching us on YouTube, head over to Facebook and join our Changemakers group, and we would love to have you as one of our members. And so when you are getting an insurance policy, and most of us are going to deal with automobile policies. There are life insurance policies, there's homeowners and policies. What you want to look at with these is you want to look at the fine print. So what we all look at when we're getting our insurance is we always want to know what's our deductible. What are we going to pay? What is our monthly premium that we're going to pay? The next thing we look at is maybe we look at what is our deductible going to be. Well, make sure you check the fine print. Make sure that you know, in addition to that deductible, any other fees that you are going to be paying. Talk to whoever is issuing this insurance and make sure that you have a fine understanding of what it's actually going to have to cost you out of pocket in the worst case scenario. So it's one of these things that we get insurance and we hope things don't happen. But that's why it's there. It is that just in case. So make sure you know what these are. Know your deductible, but also know your copays and what those are going to be in that worst case scenario. If you do not have enough to cover those worst case scenarios, consider either saving in an emergency fund to make up the difference, or decide if you might need more insurance. So another thing we're talking about, and this is going to be kind of a 2-for-1, is what is your full retirement age and what is your expected Social Security benefit? So based on your age and the year you were born is a full retirement age with the Social Security Administration. And at full retirement age, you are entitled to 100% of your Social Security benefits. And this is what you've earned from working the minimal required time frame, getting those hours in. If you apply early for Social Security before your full retirement age, then you will have a reduced benefit. If you delay, that benefit will actually be increased up. Those years are changing. It used to be age 70, and I don't have all the numbers in front of me. But if you delay receiving it, you could get an increase of about 8% per year. So just delaying 1 year, it means you're going to have another 8% of Social Security benefit. This is a complicated decision about when to take it and when not to take it. And if you are working with an advisor, this is definitely something that you should be bringing up to them and letting them know, because this is something they will figure into that. Do I have enough money saved for retirement? This is going to be a calculation that goes into that. So that is a decision about what's that full retirement age for you. Are you going to take your benefit at full retirement age, a reduced amount a little bit early, or do you delay it and take some a few years later? But you also have to know what that dollar amount is. So log in to Social Security Administration, SSA.gov, and check to see what your benefit is. So it is going to be based on the years that you've worked, and the income that you've generated is going to put you in brackets, and that's going to determine how much you actually will be receiving as a Social Security benefit. Your number is your number. It is going to be unique for you. There is a range that people will fall in, but based on your years of work and how much you have made during that time will determine how much of a benefit you receive. So please make sure you check that information out so that you know what those numbers are. When you talk about, he's mentioned that retirement savings rate, this is really going to help that, because this is going to tell you how much do you need to save. I need $5,000 a month. Well, I'm going to be getting $4,000 or $3,000 from my Social Security. That gives you a little bit less that you need to maybe worry and stress about. All right. So 2 more things. You check your debt to income ratio. So a debt to income ratio is where you combine all of your monthly debt payments, and you take your current rent or mortgage and you compare that with your monthly income. So if the ratio is 36% or less, that is considered really good by most lenders. A ratio of over 50% could make it difficult for you to get a new loan. If your ratio is between those 2 points, if you pay off some of your debt, that's definitely going to give you a little bit better percentage. This really is going to be for you and for your benefit, because the less debt you own means more of that income is going to you and meeting your needs. Gives you some availability to take some of those funds and put those and invest those for your future. Get them invested and get it working for you. The last thing, advice we have, number 10, is to pull your credit report. This is something that whenever we sat down and we have a new coaching client, this is always something that we start out with right away, is check your credit history. Chances are your credit history is fine. Everything that you're going to pull on your credit report is going to be fine. It's going to make sense. I can tell you from experience, this is definitely something you need to do. I pulled mine one time and found that somebody else's credit Social Security number had gotten mixed up with mine, and all of our information had got merged together. So it was a very easy fix. They were able to quickly see what was going on and separate it out together. I also one time found an account that I thought I had closed out because I hadn't heard from them, and I owed them a very small amount, but it had to be some like last minute charge had gone through right after I'd closed the account. And my credit score was bad because of this one little thing. I still had good credit, but this was a little ding on my account. And, it did give me that, your credit score is a little bit lower than we were expecting. So quickly, I paid it off. And as soon as that was marked as paid off, my credit score went back up to normal. So it was something that I wasn't even aware about. It had been sitting there, and it was an institution that was like, we're not going to worry about it. We're just it's on my credit report, but they weren't really looking for me and looking for the payment. So I was feeling very good because I don't like owing money. I had done a transaction. I owed these people money. And so I was able to do it. I was able to clear everything up, pay my debts. We're called, whatever debts we have, we are called to pay our debts as good Christian stewards. So I was happy about that. So really what you're looking for, we unfortunately are in this age, and we're in this age that things happen, and people get our identity, and pulling that credit report, what you're looking for is not a score, because scores can vary a little bit based on which credit card company that you go with. But what you're really looking for is all of that information in there correct. Now, I was talking with somebody the other day who pulled their credit report, and they got a little nervous. So at the end of your credit report, you're going to see a list of people that have pulled your credit. So just make sure that you realize when you get to that section that this is not necessarily credit you have, but people that have looked at your credit. It's kind of interesting because when you get that, you're going to be like, oh, that's why I'm getting all these credit card offers in the mail because this company is just been looking at my information. There are different ways that you can go about getting rid of that, and we will cover that in a future Wellness Wednesday, because that is some good information to have. There's some opt-out websites and some different things you can do. I always forget the opt-out website, so I really apologize. Otherwise, I would give that to you. But it's one of those things that I have it written down, and I sorry. I should have looked it up ahead of time, especially since I knew this was going to be one of the 10 things that I was going to talk to you guys about. So that's it. So those are the 10 things. So, find out who your advisor is and how they're compensated. Check your net worth. Establish your financial goals based on your time frame and risk tolerance. How much are you saving for retirement? That fund, that number is going to be impacted by your full retirement age and how much you're going to have available from the Social Security Administration. Look at your insurance policies. Make sure you calculate what you will have to pay in the event of a disaster. Pull your credit report and know your debt to income ratio. Number 10, the very last thing is know what you don't know. As you hear things, as you come across, if there's anything that you're like, wow, that's really good, I'd like to know more about that, write it down. Ask somebody you trust, ask your family, ask it on our Changemakers group, write it into one of our comment boxes. If you have a question about it, somebody else probably does too, and we would love to be able to answer that for all of you. So write down what you don't know and determine how important they are and how that's going to affect your financial future. Some of these things can be small little things, so they're kind of insignificant and they don't matter as much. Other things might be pretty important, and it might be something that not knowing your risk tolerance is going to have a huge impact on your investments. But there's other things that are kind of small and they won't have that same impact. So knowing what you don't know and how important that is will help you determine how quickly you take care of it. I want to thank you all for joining me. I want to wish all of you a blessed remaining Holy Week. I pray that you all have a wonderful Easter. We will be back online in Facebook Live in 2 weeks for Team Up Tuesday. Excuse me, and that's on Tuesday mornings. And then we will see you back on the first Wednesday in May for our next Wellness Wednesday. Look for that to be posted about a week out, so you'll know what that topic is and what we'll be talking about. Thank you, everybody, for joining, and I hope you have a blessed rest of your evening. God bless and happy Easter.